Hi, Larry Gaines, PowerCycleTrading.com. In this video, I'm going to show you how to hedge a trade, the S&P 500, the SPY, using a long Condor defensive hedge. Now, the long Condor option spread is a big favorite of mine. So it lets you start a trade out with a purely directional bias, but by adjusting the trade to long Condor, allows you to quickly neutralize and reduce your trading risk while still maintaining a fantastic positive reward to risk ratio. So this is an example using SPY ETF. So in this trade, we were looking at a break here of this key area of support coming in around 275. So we were looking for this to break, and then we were targeting down to this area here, 618 retracement using Fibonacci. And the other part of the trade was, okay, if we got a breakdown here, could we convert the trade or adjust the trade to make it even more profitable by converting it to maybe a long put Condor? So with this strategy, we can hedge and defend a trade, but we can also enhance a trade by adding this spread to it and creating, in this example, a put Condor. So trade one was just a put debit spread. So we went long the 273, put short the 270, and the cost of the trade was $65. That was the debit cost. So that's the max risk. Now the potential profit on the trade was still good. We have a spread width of $300 less the cost. There's 65. So if it closed below the short strike of the spread, which was 270, this would make $235 a spread or 360% return. But a lot of times shorting the markets have been hard, and you get a kind of a quick snapback rally, which you lose all your trading opportunity there. So in this trade example, when it hit down to our target around that 270 area, took profit. What you do is you take profit on part of your trade. So in this example, it took $98 per spread, which was still a pretty good return, 150%. But on the balance of your trade, you look to convert it to either a free trade or a trade where you might even collect a credit. So in this trade example, SPY dropped down and hit into that target area where we're looking at around 271, 270. So when it hit down real hard to this area, we looked to sell an out of the money 268, 265 vertical put, bull put credit spread. So credit spread here. And so when it hit down there, we were able to collect a credit of $65 per spread. So here's the short put, long put, created a credit spread here, bringing in $65. Now, when you add this trade to trade one, which was the put debit spread, that's what creates this long put Condor. So you can see here, trade one was the 273 put long, short the 270, put debit spread, $65 debit was the cost of the trade. And then when it dropped down and hit into our target zone, 271, 270, we sold the 268 put, bought the 265 below, and brought in a $65 credit. So you've got this structure here, long a put, short a put, short a put, long a put. This creates what we call a long put Condor. And this trade was then created and turned in or adjusted to a zero cost, zero risk trade by bringing in that $65 credit to offset the 65 debit. So we had a no risk trade here, and in this trade example, it went out at 271. So it wasn't a max profit, which would have been 300, but a pretty nice profit of $164 per spread. But the big thing was on zero risk. So in summary, trade one made $98 a spread or 150%, but by adjusting the balance of the trade two made $164 on zero risk. So you can see here, maximum profit would have been 300, maximum loss 0. All right, so if you'd like to learn more about these types of strategies for hedging and just creating a dynamic structure for your trades, make sure to join me this Saturday. I'm going to be doing a live free option workshop on trading strategies like this, along Condor, butterflies, and much more. Good luck trading.